Market trying to rally today as we continue in this holiday shortened trading week. We'll talk about it on today's edition of 3 Minutes on Markets and Money. So very interestingly, the market as of yesterday's close is only up about 2% this month so far. Now, that's kind of hard to imagine considering we had this 5.5% jump in the S&P following that weaker than expected CPI report. And since then, though, the market has really not gone anywhere. In fact, we're exactly at the same point the market closed that day over a week ago. So the market's pretty much just gone sideways now here for several days. Market looking to point up a little bit this morning. We'll see how the market plays out today. We've been seeing a lot of this kind of consolidation action all week. Market's either up a little bit or down a little bit, but really not doing a whole lot. Again, inmates running the asylum this week, so not a lot of activity or volume here to really drive the markets. The good news, again, though, is that markets are continuing to consolidate above this 100-day moving average. That's allowing the 20-day moving average to now catch up to it. So again, this is providing some additional support for the markets near term. And as we've talked about going into year end, we might see a little bit of selling pressure come the first couple of weeks of December as mutual funds distribute their funds for the year. And then we get that rally into end of year, which puts us right around our target of 40.50 to 4,000, somewhere in there by the end of this year. Now, again, that 4,000 to 40.50 level will be a good spot to raise some additional cash and reduce equity exposure. We did that yesterday, actually raising and taking some profits in our energy positions. Energy stocks have been down about 5% this year versus a much bigger decline in what we have seen in oil prices here recently. So again, oil prices down about 20%, but energy stocks only down about 5% from the recent peak. So again, taking a little bit of profit there as we took an opportunity to put some profits on the books. Also still doing some tax loss harvesting as well, heading into year end, reducing that overall equity risk exposure. Again, as our expectation is that as we get into the beginning of next year, all these Fed rate hikes that are in the system right now will start to show up. Weaker economic data, weaker earnings estimates, and reduction in estimates, particularly for 2023, as that tighter monetary policy tightens its grip on economic activity. Now, that will suggest, obviously, markets will have to reprice lower. However, that lower repricing will likely be the last leg of this kind of bear market cycle we've been in. So the good news is we are getting closer to the end of this kind of grinding cycle in the markets, and we'll want to be prepared coming out of this to take advantage of markets. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you back here tomorrow.